Wei Li, head of iShares EMEA investment strategy at BlackRock, is with us on set to discuss this and more. Great to see you, Wei. So one thing that's been interesting through all these trade tensions, of course, we've seen it reverberate through FX markets, but the S&P 500 in the US has held up fairly well. In fact, that 2,800 level seems to be acting as a floor now rather than resistance. What are you seeing in terms of ETP flows across the global equity landscape?
Yes, of course. What we have seen in flows so far year to date is that investors are a lot more cautious in comparison with prior quarters and the whole of 2017. And there has been greater selection, greater degree of wanting to decide where I put my risk budget to, and alongside that there is greater focus on diversification for precisely that reason, trade tension weighing down on sentiment. So in terms of the degree of greater selection, we have definitely seen investors putting money to US equity markets out of European equities and more recently out of emerging market equities, and I think the former has been supported by more robust growth outlook as well as very strong earnings momentum. We saw that coming through in past weeks. And the latter, in terms of kind of outflows from emerging market equities, outflows from European equities, have really been on the back of, well, a reasonably strong dollar weighing down on sentiment towards emerging markets. And Europe, political uncertainty, very fragmented politics have been weighing on that.
Mm-hmm. We had 6 weeks of losses for metals, Wei Li, and currently we're seeing a bit of a rebound, especially in aluminum. It's such an important indicator for the health of the global economy and for expectations on future expansion. What are you seeing in the flow data at the moment in terms of the wider commodity space?
We have actually seen very volatile flows when it comes to commodity block as a whole, but I would also caveat that by saying not all commodities are made equal. You have industrial metals that are very much sentiment barometers of kind of expectation of where growth is heading towards, and you also have gold and to some extent platinum, very much kind of safe haven. You see investors going into them regardless of price movement in order to diversify their portfolio. So specifically, you talked about aluminum, industrial metals. We have seen more recently kind of outflows followed by speculative buying in this space, and I think the rationale behind that is very much investors kind of looking at to what extent the exposure has sold off and weighing that alongside, does it really warrant this degree of price correction given where growth is heading towards, and I think that's where the speculative buying is coming from.
Wei, as we look ahead to this week, we're going to have quite a number of tech earnings. I just want to show you this chart, which shows that tech megacaps underperformed the S&P 500 last week. So on a weekly basis, tech megacaps down the most since March relative to the S&P 500. Does tech continue to be your preferred sector, and if so, why?
Tech, it is our single biggest conviction on a sector basis when it comes to investing in U.S. equity market. We think earnings is just getting started. Earnings coming through is just getting started, and we hope to expect to see that coming through in the numbers that will get reported this week. And also we see, even though tech on a longer-term horizon year to date has outperformed the broader market, it's been really not moved significantly away where EPS growth has been. So in terms of the actual multiples, it's been kind of going sideways. And if you think about companies having more cash to spend on the R&D, capex expenditure, and a lot of that would also focus around kind of technology, innovation, and that should also support the sector as well.
Just very quickly, in your view, this concern and this fear around tariffs and trade tensions, is it disrupting the equity flows a bit too much, or the broader flow space a bit too much? I mean, do you think it's overblown?
What we have seen so far, especially in recent weeks, the last couple of months, is that no new money is being deployed, not to a large extent anyway. It would appear that investors are just kind of rotating within the different buckets of the various asset classes rather than taking cash off the sideline into market. And I think that has to do with the fact that, well, now there is greater competition for cash in that the front end of the US curve and also high-grade credit, the front end is yielding higher than before, even after adjusting for inflation. But because of this very hesitant participation into market and still strong growth, we think that there is room to correct.